Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. Thank you for joining us today for our webinar, Taking the Stress Out of Taxes Year-End Planning. I want to apologize, first of all, to all of you who tried to tune in last month. We had a little bit of a mix-up. We wanted to wait until after Thanksgiving to see what Congress did with the new tax plan. And while they're still negotiating and trying to get the final bill passed, we hope that we have an idea of what things are going to look like for this year. My name is Waldo Smith. I am a business counselor and the director of microlending for the Wyoming Women's Business Center. And I'd like to welcome you. We also had a last minute change in presenters. So our presenter today is Roberta Johnson. She is the senior associate accountant at Anton Collins Mitchell LLP, formerly known as Mader Chalker Peterson and Company. So she's going to be talking to you today about year-end planning for taxes, what you can do to take the stress out of the tax season and help your accountant out as well. All of you are muted to help reduce background noise. And so if you have a question, if you'll notice on your GoToWebinar session box, there is a place called questions and there's another one called chat. And if a question comes up during the presentation, please type it in one of those boxes and I will be monitoring those, and then I will pass those on to Roberta as they come in. I want to remind you, as you leave the webinar today, please fill out the questionnaire at the end. This helps us document who was here and provides us information that we can then pass on to our funding providers. And this webinar is being recorded and will be posted to our YouTube channel at the end of the day. So if you want to review it again, all you need to do is go to YouTube, type in Wyoming Women's Business Center, and you can view it again at any time at your leisure. So with that, I will turn it over to Roberta, and thank you again for joining us.
Thanks, Waldo. My name is Roberta Johnson, and I am with Anton Collins Mitchell Accounting Firm. I have been with them for 5 years now, and I do audit, tax, and also payroll and financial statements. And a lot of times it can be really stressful and scary to get your taxes ready and to do your taxes. So I just like to add a little bit of humor in it because sometimes it's frustrating as well. And this is just one of my cartoons that I found that I thought was kind of cute. I hope I get a big enough tax return to support the drinking habit I've formed from filing taxes. So hopefully we will get some of the stress out for you today and get some of the questions answered that you might have. One of the biggest things that we like to tell our clients is to start early and keep up with their stuff. And when you're starting, you want to get your stuff as organized as possible. We have clients that are any size from very small who just they just started out, don't have a lot of transactions, so they may bring us in their information in the form of a list or just written on a piece of paper. And that's fine if that's what works for you. The biggest thing is to find something that you're comfortable with and that works for you. And then as your company grows and gets larger, you will probably want to move to maybe Excel or Quicken or QuickBooks. And when you're getting that started, you may want to consult somebody to help you get that set up so that it is set up correctly the first time and that you can just keep going from there and that it stays correct and that you're not trying to clean up big messes. QuickBooks and Quicken are nice because you can download information from your banks and from your credit card companies. And the other big thing is for you to keep the information in a form that is understandable for you, that you can explain when you take it to the accountant, and that it's easy to read and follow. Those are some of the biggest things. Another thing is that it's better to get your stuff in early, because once tax season starts, people just start bringing stuff in. And at the beginning, if we get your stuff in here and get it going, then it'll be done first. And as the tax season goes on, we get more and more stuff, and it may be down the line. If you bring it in March, we'll tell you we'll try to get it done by the deadline, but we may have to do an extension for you, because there's now been like 300 people bringing their stuff in, and we have 300 people before we can even touch your stuff. So it may take a lot of time for us to get to it if the later you bring it in. So the items that we need to prepare your tax return are year-end bank statements and reconciliations. That is the December 31st for most of you. It may be different if you have a different fiscal year end, but we don't need all of your bank statements. We just need, unless you're having us prepare the books as well and enter transactions for you and things like that. But again, that takes a little while. If you bring in a whole year of stuff at once, it's going to take a while for somebody to compile all that and enter all those transactions and reconcile all the bank accounts and everything. So if you are bringing in your stuff and you already have a QuickBooks file or an Excel file and you have your statements prepared, then it's a lot faster than if we do the whole thing. Or if it's easier for you, you can bring it in and have us do it monthly or quarterly. There's all kinds of options with that too, if you're getting to a point where you're so busy that you can't do it yourself. But we do need the year-end bank statement so that we can tie out your tax return numbers, your cash balance, to your actual bank statement and reconciliation. We also need a balance sheet. A balance sheet is just the financial statement that tells us all of your assets and liabilities and owner's equity. Your assets are going to be like vehicles or buildings, things like that. Your liabilities will be any of the loans that you have outstanding on any of those big purchases or buildings and stuff like that. The income statement is where you will have all of your income and expenses recorded, and we need to see the detail with that. The more detail you give us, the better, because we can understand what you bought. Like in the memo, if you go to Walmart and purchase something and it's all office supplies, if you just put in the memo office supplies, then we know that's what it is. But if you have a bunch of different things, list as much out as you can so that we know what those items are, and we can make sure that they're classified in the right accounts. We also need a detail of any assets purchased, like if you purchase a new piece of equipment or any sales or disposals of equipment, because that will make a difference in your tax return. As far as if you have those being depreciated out and things like that. There's a $2,500 limit, which is where you start to capitalize items and put them on your balance sheet as part of your assets. And so anything under $2,500, like chairs, office equipment, tables, things like that. If it's under $2,500, you can expense it right away in an account like office supplies or small equipment and stuff like that. Just completely expense it. If it's over $2,500, then we need to put it on the balance sheet as an actual asset. So it's capitalized on the balance sheet, and then we have to depreciate it each year. You get to take a certain amount of depreciation on that, so you don't get to expense the whole thing at once. And it's important for us to have those so that we know, and if you dispose of an item, then it's important to get that off of your balance sheet as well as getting purchases on. We also need year-end loan balances and the total amount of interest paid for the year. And it's okay if you don't know how to break out the loan payment and the interest, if you just put all your loan payments in loan payments account or whatever account you want to call it, boat payment, whatever, then we can look at that if we have your loan balance and the total interest paid, and we can break it out, and then it gets allocated correctly. The interest is expensed immediately, whereas you can't take the actual payment out. Then shareholders' equity is important. Not all of you will have that. If you're a single member LLC or a Schedule C person, you're not going to have shareholder equity. This is more for S corps and partnerships. And when you get bigger and you're starting to have, like if you wanted to give part of your company to your sister or your brother, that's when we get into starting to allocate some of that, let them have part of the company. So now you don't own the whole thing, and we have to split those things out, and they get kind of complicated. Or if you're gifting part of it to your grandkids or something, then you may have different ownerships in the company, which affects the different amount of equity. And it has tax implications for that as well, as you won't have 100% anymore, and other people will have a percentage as well. And then we will have more people that we need to prepare K-1s for, which is how those entities flow through to your personal tax return and how they get taxed. The other things that we need, if you do payroll, we need a copy of all of your payroll reports that you filed during the year, including all 941s, 940s, unemployment and workers' comp, W-3s, W-2s, and 1099s, along with payroll summaries used to prepare those payroll reports. That way we can tie them out and make sure that there wasn't anything missed, and we can match them up. And the IRS is getting a lot more sticky on those, especially the 1099s. They expect that if you paid anyone for services for over $600 in services, that you will prepare and send them a 1099. So it's important to get W-9s from those people, which is kind of like your employees filling out the W-4. The W-9 is like a W-4, but it's for people that aren't actual employees. They're more contract labor, like somebody that does yard work for you and snow removal. If you pay them over $600, then you're going to want to send them a 1099. And then any other important tax documents that you receive in the mail. If it says tax document, important tax document, bring it in. We don't mind getting those at all. But what we don't want is just a big box of every single bank statement for the whole year or all your receipts for the whole year. The more organized and cleaner the information that you bring into us, the easier it is for us to decipher and prepare. Common problems that we find when we get into doing the taxes and trying to tie things out so that we can get the taxes done. A lot of times we'll see people that have expensed items that should be capitalized and depreciated. Repairs and maintenance is a big one, and the IRS rules on repairs and maintenance and equipment and supplies. Some of it can be really tricky, and so If you put it in repairs and maintenance, that's fine. We may have to move it over to the balance sheet and capitalize it. If it's like a piece of machinery that you need and you just have it in supplies, we'll probably have to move that over to the balance sheet. Anything over that $2,500 will have to be capitalized. And so we have to move that, do a journal entry to move that to the balance sheet. The other thing we find is people that are capitalizing items that should have been expensed. Like, we have some people that think that any kind of furniture has to be put on the balance sheet and capitalized. So we have a bunch of items like $300 chairs or a new computer that's $500. Those things can be expensed. The IRS has deemed that the new limit is $2,500. So anything under that, you can just expense as supplies or office supplies or regular supplies or farm supplies, whatever account that works for you. We also see expensing items that are not allowed to be expensed. Personal use items are a big thing, or fines because you paid something late or you got a ticket for something. Those are not allowed to be expensed through your business or on your personal tax return. So those items aren't allowed. If you have a question on any expenses, then feel free to call us, or there is a really cool account that is, I think, in Quicken. I know it's in QuickBooks, and it's called Ask My Accountant. If you put anything you don't know where it goes in that account, we always look at that account to see what's in there, and we always make sure and move everything out of that account into the appropriate account that it belongs in. Because we do see a lot of recording income and expenses in random accounts. And that's really hard for us to follow. Then we have to look at numerous accounts, whereas if you just stick everything you don't know where it goes in that Ask My Accountant account, we can find it really easily because we know you always stick everything you don't know about in there or anything you have a question about in there. It's harder for us to get everything where it should be when we have a miscellaneous account or several random accounts. Like, you put it in supplies this time, and then the next time you put it in maintenance, and the next time you put it in a different account. It's easiest if you keep the less amount of accounts that you have, the easier it is to keep track of where you're putting things and be consistent and put things in the same account all the time. And then it's easier for us if we need to move things around. Reducing the time and expense of tax prep. We get a lot of questions on that. Well, how can I reduce the time and expense of my tax prep, because it seems like my bill's going up, or it seems like I pay a lot for this. And again, organization is key in this. If you bring me in a box of every single receipt for the whole year, then it's going to take time to go through that. And it takes a lot if it's organized in file folders and stuff like that, where everything's in specific folders that tells us what they are. It's a little bit easier, but again, it still takes time to go through all of that. If you, and again, if you turn your tax information in as soon as you can after the first of the year, then it will be in here first, and it's first come, first serve. We can't push people up in the line or whatever. We actually go through our inventory and make a list, and when it comes in, everything's dated and it goes through the process in the appropriate order. So the sooner you get it into us, the better, because again, we have a lot of people that are late and turn it in late, and at the end we have like people waiting there's 100 people ahead of them. So don't wait. And if you're missing only one or two items, say you're waiting for a K-1 from somebody or a interest statement from just one place, still bring your stuff in, because then we can get it in process and start working on it. And then you're already in line and yours is already being processed and worked on. And we know if you leave us a note that says, I'm just waiting on one statement and I'll bring it in as soon as I can, then we can process it most of the way and know that we're just waiting for that statement. And then as soon as you bring it in, we can just pop that statement in there and that information and finish the process and get you through faster. But if you're missing a whole bunch of things, like 5 K-1s or W-2s, 1099s, then don't bring your stuff in. Then we just have to spend more time calling you and asking you for a bunch of information that it's trickling in one at a time. And then if people think, the tax preparer thinks that they have everything, they work on it, then they stop, they get a few more things, they start to work on it because they think you turned everything in, and that's a time waster as well. It's a lot faster if we just go into your file and complete it all at once, unless there's just 1 or 2 items left. But that's the reason we don't want you to bring in your tax stuff if you're missing a bunch of stuff, because it'll take more time for us, and that might cost as well, because somebody has to open the file 5 times to put additional information in. But if you're just missing 1 or 2, we do want you to get it in there so that we can get it done faster. Again, the more information we have, the better detailed memos in there. If you buy a new truck and you put it in supplies or whatever, if in the memo you have put 2010 Ford F-150 truck, then we know, and it's easy for us to see that and move that over to the balance sheet. And just like with supplies, if they need to be split or something, and you put it in supplies, and in the memo it says ink cartridges, paper, whatever, then we know that's what that was, and it's easy for us to say, okay, yep, that really was, even though it was over $2,500, it really was ink cartridges and supplies, so it stays in supplies. We don't need to worry about moving that over to the balance sheet and capitalizing it. We really like it when our clients bring us in an accountant's copy of QuickBooks. Makes it easier on us and on you, because when we get an accountant's copy, we can go ahead and make a copy of all of the journal entries that we have to make to get your tax return prepared. And then we just send that to you, and it will clean up your books, and it will automatically download all of those journal entries that we had to do to get your tax return prepared. That way, if you go to the bank and ask for a new loan or something, and your bank says, oh, well, I need your financial statements, and you print out a balance sheet and a profit and loss for 12/31, it will match your tax return. Whereas if we just give you the journal entries and you don't make our journal entries, then your tax return and your financial statements aren't going to match, and the bank's going to be questioning a lot of stuff, and they're going to wonder, why doesn't this financial statement match the actual tax return that was prepared? So that's a really good way to get your books cleaned up and tied out for the year end. And then don't go back and make any entries to that prior year. That causes a lot of problems too. So if you do those things, then we don't have to do them again. A lot of times if you don't make our journal entries, or if we don't give you an accountant's copy and have those logged in there, then we're making entries that are for several years past. Like, okay, I got this I've been doing it since 2014, and they didn't make those entries, so I have to make those entries plus the 2015 plus the 2016 to get it to the actual balances where it should be. And if you're unsure of where something goes, or you have a question about something, just call us and ask. We are always happy to help, and we don't charge for short little calls here and there, and we'd rather have you call us and ask us than keep creating extra accounts and putting things places where you don't know where they are. It's hard for you to remember too. If you put something in an account that doesn't make sense to you, then if you put it in the Ask My Accountant, or if you call us and ask us, and we're always happy to help, and we don't charge for those short little phone calls. Changes in tax law, and another funny. I wonder if I can claim the federal government as a dependent on my tax return this year.
Hey, Roberta, I've got a quick question for you.
Okay.
Would you, if I've got questions during the year, would you rather I wait till I bring my stuff in to ask you questions, or would you rather I contact your office, say in June, if something comes up and I have a question on how to enter stuff so that I can get them ready for tax season?
Nope, we would rather you call us throughout the year so that you have your stuff in order. The better organized again, and the more prepared you are, the better. So we would love it if you have a question even in January when you're first starting your new year and you're like, oh, I don't know if I want to do that. Oh, let me call real quick. We do not mind questions like that at all. We would love for you to call us whenever you have a question, or if you just have a question of, is this an asset? Does this go on my balance sheet, or is it an expense? Where should I put this, or how do I do an entry? We have a really, really good accounting department that does bookkeeping and payrolls and everything, and they're really good at walking you through how to do entries or create accounts that you need created, and how to help you put them in the right places. So okay, we would love that if you call us during the year.
All right, thanks.
So some of the changes in effect for 2017 and 2018. Well, 2018, as you know, is pretty up in the air right now. There was a little article this morning that we got that said that they actually have made an agreement that they are going to start pushing some things through as early as next week on some of the new tax reform and stuff. But we don't have any idea right now of what exactly those things are. So we're going to have to wait till next week on that. And a lot of that has to do with who gets elected or selected to be in those positions. So right now, we know that there's rumors that a few things are going to get pushed through quickly that are more important that both sides agree on. And then some of the other things will probably get pushed back, and it'll take a while for them to go into effect or for them to negotiate those things. But as far as things that we do know about already, we do know that W-2s and 1099 miscellaneous are due on January 31st. And that means both to the IRS and to the employees or contract labor people. And the IRS is really cracking down on these, and they do give penalties. I know the W-2s are like $50 per W-2 that is late. And that's for like 30 days late. And then anything over that, it's $100 per W-2 that's filed late. So just remember those kind of deadlines if you do payroll or if you have contract workers, that those services that they provide that you are over $600 that you need to send a 1099 to them. Individual tax returns, single member LLCs, Schedule C filers are due on April 17th this year. It's normally the 15th, which has not changed. That's the same, but we have this fun little holiday that they have in DC. And so that's why it is pushed back a day. And then partnership tax returns are due on March 15th. That is the same as last year. S corporation tax returns are due on March 15th this year. That is new. They were due April 15th, and now they've moved it to March 15th to streamline it a little bit, and that is in order. They wanted to have the partnerships and the S corps done the month before personal tax returns were done, because the S corps and the partnerships, which are 1120S and 1065, those are where you get your K1s. If you have a partnership or an S corp, that is what flows through to your individual income tax return and what your taxes are based on. So they pushed that S corp one back with the partnership one to March 15th so that it would give people a month to get those from the tax preparers in order to get ready for the individual date of April 17th. So hopefully that will be a little bit better, because in the past we've had to wait on some of those documents to do returns. Regular corporations are due on April 17th, and that is not changed. Personal and business tax rates. Personal rates are where the Schedule C comes in, and those vary. When you first start, you're probably going to be in the 10% tax bracket, and then as your business grows, you're going to go up into the higher brackets. And that's where, if you have your stuff up to date and clean, and you start noticing you're making more, you have a lot more income, and your expenses are staying about the same, so you're feeling like you're going to get into those higher tax brackets, there are some things that we can do to help mitigate some of those tax repercussions from making more money, and things that we can do so that it lessens that tax rate and keeps it lower for a while. On the corporate income tax rate is anywhere from 15 to 35%, again, depending on how much the corporate income is. Business mileage rates, the IRS standard mileage rate is 53.5 cents per mile for business miles. And a lot of times we have a lot of people that use that because it's really easy for them to just keep a logbook every time they go somewhere, and every time they get in their car, they just jump in and write down how many miles they drove that day. And that way they can, at the end of the year when they bring it in, we just take their total number of miles that they drove and multiply it times that 53.5 cents per mile, and that's what they get for their business mileage. That also includes a little bit of wear and tear. That rate that the government rate that they give us includes like stuff for maintenance and like tires, things like that. So they take that into account, and you will always get more than what you would actually spend on fuel and things like that. And that's to compensate for the wear and tear on your vehicle. The mileage rate for medical or moving purposes is 17 cents per mile. We don't see a lot of medical because the medical deduction is so hard to attain, which is a good thing. You would really have to have a catastrophic event happen for you to probably be able to claim medical, or have somebody that has a lot of medical needs to be able to claim medical on your tax return. But moving, if you move somewhere for a new job or something, then you can take that 17 cents per mile for that. And then if you do things for a charitable organization like Meals on Wheels, you can claim 14 cents per mile for all the driving that you do for that. Just need to keep a little logbook of the miles that you drive when you're delivering. And these rates are in effect for the entire 2017 year. We've had a few years where the gas prices have gone up or down drastically, and so they've had different rates during the year. For half of the year, January through June, it was a certain rate, and then July through December, it was a different rate. So those were a little bit complicated, but most of the time they stay the same once they decide. And I checked online and I have not seen the 2018 one out yet. The tax rates for Social Security remain the same, and the maximum is based for 2017 has increased, and it is based on 127,200. So everyone will get taxed for Social Security and pay in Social Security taxes until they reach $27,200, and then after that you wouldn't have any Social Security taken out. It mostly affects employees that are high wage earners. We don't see a lot of that. Probably the people it affects the most are like people that are, I've seen a few pilots, doctors, things like that that make more than $127,200 per year. Or if you have two jobs, then you may end up making that from your business and your employment job. If you work a job and get a W-2 and you also run your own business, then you may get there that way as well. The additional Medicare tax is continuing through this year, and that's not new, but it is an additional Medicare rate of 0.9% that's applied to combined employment income and self-employment income. And it only applies to income that is above $250,000. So not a whole lot of people get that additional tax. We see a few, but not too many. Don't have to worry about that too much until you're really making a lot of money. And the additional tax has to be withheld from the employee's pay above $200,000. For self-employed business owners, this additional tax is included in your self-employment tax calculation. Also, we have a net investment income tax of 3.8% on investment income, and that is, again, mostly we see that on higher income people, including business owners, but ones that are earning a lot more than startups. We also have an increase in depreciation deductions, which is nice. That means that if your business purchases, we have what's called the Section 179 deduction, and if your business purchases a large piece of equipment, you're having a really good year and you're like, oh, right now it looks like I have a profit of $200,000 and I'm going to owe a lot of taxes. And if you need a piece of equipment and you were planning to purchase it anyway, then you might want to go ahead and purchase it before the end of the tax year, so that it brings your income down a little bit and offsets those taxes a little bit. Because the Section 179 deduction is if you buy something up to $500,000 or many items up to $500,000, they will allow you to go ahead and expense those purchases in the current year instead of depreciating them over the next several years. We also have what is called bonus depreciation, and that has been reinstated. It is going to be phased out over the next few years, but it is an incentive for businesses to purchase new equipment instead of used equipment. And it's for 2015 and 16 and 17, it was 50%. So they'll allow you to expense 50% of any of those large items that you buy or new items that you buy. And then in 2018 and 2019, it will be 40%, but they're trying to encourage people to keep purchasing new equipment instead of used equipment. So they give you that bonus saying, oh, here, if you purchase that new equipment, then we will let you deduct half of it this year instead of over the next several years. So best practices for preparing accurate and complete financial statements. And I had to put another cartoon in here. Here's one my cat threw up on. Here's one I used to wipe my nose, and here's one with a blood stain. These are the only gross receipts I could find. So again, key to success in financial statement is, again, organization is key. The more organized you are, the more consistent you are, the better your financial statements will be. The most important thing is to establish a good system, and that doesn't mean it has to be QuickBooks or Quicken or automated. If you're a small business, then and you can just write your statements out on a piece of paper, then on the old green ledger paper, and it works for you, then that's great. But if you're finding that you're getting to the point where you have so many transactions and things that you are having a hard time keeping track of them, then you might want to think about automating that system. You can use Excel, you can use Quicken, you can use QuickBooks, and then you can pull financial statements out of QuickBooks, which is really nice. One of the biggest things is getting them set up properly, especially the first time. If you're wanting to automate them and go to QuickBooks, then ask for help. We're more than happy to help people get their stuff set up correctly. And if you have any questions, again, call and ask us. We can help you over the phone even sometimes. Sometimes we can remote into your QuickBooks and walk you through it and go through it with you. It just depends on what versions you're using or whatever. But setup is really important. If you start doing it the right way and keep up with it and keep doing it the right way, then it's much easier at the end of the year to get it to tie out. And keep up with your transactions. Enter them regularly. Don't wait until the end of the year, because you might find that you have a lot more work to do than you thought, and it's going to take a big chunk of time. If you just plan and set yourself a time, I know it's tedious, I know I don't like to do this, but I have to it'll take me an hour if I just do it. Once a week, once a month, whatever schedule you want to come up with, but we encourage people to do it regularly. That way anytime you have a question on, where am I at? You know what you have, and you have a better idea of really how your business is doing. We also encourage you to record your transactions correctly. If you go buy something personal, put it in Ask My Accountant, or put it in an account called Personal Items. We encourage all of our clients to have completely separate checking accounts and a credit card for their business, that you do not ever purchase anything personal through the bank account or through the credit card. And it's very hard to do that sometimes, but it's really important to keep them separate. If you are charging personal things in your business account, then you really can't tell how much you're making, or you're going to have expenses in there that show, it's going to show that your expenses are inflated and that your company isn't really making as much money. Whereas if you don't have those personal expenses in there, then you can see exactly really what your company, how your company's health is and how it is doing. So we encourage no personal transactions or commingling in there. We also encourage our clients to reconcile their accounts regularly. Your bank account reconciliation, if you have any issues with that or need help with that, we're happy to help with that as well. And it's a really quick, easy process in QuickBooks and Quicken, and those are both automated. There's also a lot of ways that you can import those in. We can set up an Excel spreadsheet to do a reconciliation. You don't have to do Quicken or QuickBooks. We can set up one on paper. The one that you see on the back of your bank statement works. Whatever is easiest for you and most comfortable for you is what I would use. It also really helps to have your financial statements reviewed quarterly. If you bring your stuff in quarterly, then we can look at it and see if there's any accounts that look out of whack, or if there's any kind of a problem. And if we catch it then, we can fix it, and then the next quarter isn't as bad, or the next quarter. If you wait till the end of the year, then there may be a problem that we could have fixed way back in the beginning, but we didn't know because we didn't see any of the statements or what was going on. And again, that's important. If you keep up with your stuff, then you'll know if you're having a problem area, and we can sometimes help with that. And another funny, I like the short form instead. This is the short form. And I think that is it. And this is my contact information, and also Abby Hagerman and I gave this presentation this morning at a roundtable, and I put Abby's on here as well, and we are always happy to help with any questions that you have. And we would rather you keep your business healthy all year through than try to clean it up and have a bunch of stress at the end of the year.
And if you're interested in obtaining a copy of this presentation, I do have that. I could email out to everyone. Roberta and Abby were generous enough to send it to us, so we have that on file here. Roberta, if I could summarize, I think what I heard you saying most of all was keep current, use a system that is easiest for you, most convenient for you, and don't be afraid to call and ask questions at any time.
Yes, that's correct. Those are the probably the three biggest things.
Now, I used to work in banking, and I had a lot of farm customers, and I know this time of year they were all going to their accountant to get advice before year end, and a lot of them would always write a bunch of checks at year end to prepay for things, to buy equipment, so that they could reduce their taxes. If I had a really good year for business and I know I'm going to have a big net income, are there things I can do this time of year to help reduce those taxes? I think you talked a little bit about that.
Yes, definitely. We do have a lot of clients like that as well. Our construction companies and excavation companies and stuff, and some of our farms and ranches come in. They have been the last few months and have been bringing in all of their stuff and asking us to go through it and see where they're at, so they know, well, I know I'm going to need this, but do I want to buy it this year or do I want to buy it next year? And we do look at that and see if you're having a really good year, then you may want to purchase that item before the new year so that you can reduce your taxes a little bit this year. And then the other things that we usually recommend are maybe a 401k or an IRA or a Roth IRA. Sometimes those things we have our clients sock money away in there if they haven't done that, or HSAs or any kind of savings plans and stuff that will help them reduce their tax bill a little bit.
Okay. I've got a question come in that says, I pay office rent each month, which adds up to more than $600. Do I need to give my landlord a 1099 form?
Yes, rent is a 1099. It requires a 1099.
So it's anything that a service that's provided to you, and you pay more than $600 for, you should send a 1099.
Yes.
And those have to
unless they are a corporation. If they have a corporation, then you do not need to issue them a 1099. But if you do, it's not a big deal. We'd rather have you do it and they didn't need one than have you not do it and get in trouble for it later. The fines are really getting stiff for that.
Okay. Are there any other questions? If not, I would like to thank everyone for joining us this afternoon, and thank you, Roberta, for taking time out of your day to present for us. You've given us some valuable information that I know everybody can use going forward. And just want to remind everyone that this webinar has been recorded, so it will be posted to our YouTube channel. Our next webinar is scheduled for January 11th at noon. Again, that is a Thursday. Our topic will be, how is your business doing? Year-end recap and goal planning. So we'll have some strategies, things that you can do at year-end to help review how things went and looking ahead for the next year, what things are going to look like. We ask again that you remember to fill the questionnaire out as you leave the webinar today, and I want to wish everybody a Merry Christmas and a Happy Holidays, and thank you all for joining. This concludes our presentation, so have a great day.